Hey everyone, and welcome back. In today's video, we're going to be going through an interview from Bloomberg of Joel Greenblatt. Now, this interview is about a year old, but it is still packed full of tons and tons of knowledge. So I wanted to go through and sort of consolidate some of the major parts of this interview. It's about 10 minutes long if you want to check it out. I highly encourage that you watch the full interview after this if you're interested to get all of the other little snippets that I didn't include in this video. I'll leave it linked down in the description below. But essentially, I consolidated all of the major parts, and I'm going to go through and explain further in depth to make it a little bit easier to understand, as well as provide my opinion on some of the topics that he speaks about in this interview. And for those who don't know who Joel Greenblatt is, essentially he's a very successful value investor. He started Gotham Capital, which was an investment firm, all the way back in 1985, and from 1985 up until 2006, that firm generated an annualized return of 40% per year. So he definitely has a great track record, and in today's video we're going to talk about why he loves gushing cash flows. If you do enjoy today's video and you want to see more, I would very much appreciate it if you could hit the subscribe button or just leave a comment down below. But with that said, let's get straight into the interview.
So I want to remind everybody that you are a security investor, which means that you buy individual stocks and in some cases sell individual stocks short. But the natural question many people would have for a value investor right now is this: after a 10% or almost 10% sell-off, to the degree that you look at the market and decide whether it's cheap or expensive, is it cheap?
Sure. So we actually value all the businesses in the S&P 500 bottoms up, and we have good data going back to 1990. So we can actually contextualize where do we stand today according to the way we value, our measures of absolute and relative value that we use, and we apply them consistently over the 28 years.
All right, I just want to stop here very quickly. I know that I didn't let him go on and explain and talk about what he was about to talk about, but I just want to make it very clear sort of what kind of value investor Joel Greenblatt is, because if you've heard me throw the term value investing around on this channel, then you might think that he is the kind of person who buys maybe 5 to 10 businesses over his lifetime or something like that, and he's that kind of value investor. That's not what he does. So essentially, he has certain measures that he uses in order to value a business, in order to work out what it is worth. And then him and his team do that for every business in the S&P 500. So this is very different to something that like I would do, where I'm focused on a small number of businesses. He's using metrics to value every business in the S&P 500. And then he operates what's considered a long-short portfolio. He invests in every single business in the S&P 500. Some of them he will invest in long, meaning he just buys the stock. And some of them he will short, meaning he sells the stock short and he benefits if the stock goes down. But his portfolio, or the main portfolio that we're talking about here, is a long-short portfolio where he has positions either long or short in every single business in that portfolio. So straight away, this is very different to the traditional value investor who you might think of someone like a Warren Buffett, who is focused on a small number of businesses and his wealth is concentrated in just a handful of businesses. That's something that's very different to what Joel is doing here. But I guess the next logical question that you would be wanting to answer is, how does he value a business? What are the metrics that he's using to value all of the businesses in the S&P 500? And we will certainly get to that throughout this interview.
The market has repriced from its peak PE by about 4.5 times. Do you see that as healthy?
We don't really look at PE. We're really looking at cash flows,
okay.
And so we're pretty consistent about that. And so...
Right, so this is the first hint that he gives towards what he's looking for when he's valuing a business. And he explains this a little bit further in depth throughout the interview, but he sort of gives a hint to it here, and he says that he's looking at cash flow. He's not looking at traditional profit metrics. So if you look at any institution when they're looking at value, most traditional institutions, investors, they will be looking at earnings per share, EPS, or net income. And these are measures that you find on the income statement. Earnings per share being net income divided by the number of shares, and net income, of course, just being the profit figure on the income statement. But Joel Greenblatt does not use any of these metrics. He uses cash flow. And there's one major reason why you would want to focus on cash flow, and it is that it is much less easy, it is much harder to manipulate than earnings per share and traditional profit metrics such as net income. And the reason why is because in earnings per share, in net income, and in the income statement itself, it includes non-cash charges. So it includes incomes that they received on an accrual basis, but they haven't received them in cash terms. They haven't received the cash yet. And it also includes non-cash expenses, things like depreciation, where there's actually no cash that is leaving the pocket of the business, but it appears that way on the income statement. So there's a lot more room for management to move around non-cash charges and manipulate that earnings figure on the income statement compared to cash flows, which are measures of the real cash in and outflows of the business. If you're looking at cash flows, there's really only one way that they could manipulate those numbers, and that would just be with straight out fraud by just changing the numbers on the cash flow statement and misrepresenting them. And that's obviously something that could still happen, but there's no other sort of sneaky legal way for them to manipulate the cash flow numbers, and it's why it's a much better representation of how much cash we get back from a business as investors, because it's ultimately the real cash number is the real amount of cash that the business could ultimately pay out as a dividend or do share repurchases.
What could happen from here, in the 22nd percentile with expected returns of 4 to 6%? One way to get back, and no guarantee that we get back to those expected returns of 10% or so, but one way you could get back there is if the market fell 18 or 20% tomorrow, the expected returns going forward from there would get closer to 10% a year. But that doesn't have to happen, because if the market just under-earned, meaning had subnormal returns of 4 to 6% in each of the next 3 years, then 3 years from now, with a normal earnings trajectory, we'd also be back to a 10% expected return. So it's really not helpful for me to know what's going to happen in the next few months, but it is.
Yeah, that's super important. And this is one of my favorite parts of the total interview itself. And it's that just because the market is expensive, it doesn't mean that there is certainly going to be some kind of short-term correction. I think this is something people get wrong quite often, is that they'll look at the traditional measures of expensive markets versus cheap markets, looking at the price compared to the earnings or the cash flows that the businesses are producing, and they'll say, hey, it's expensive relative to the past, therefore we're probably going to see some kind of dramatic crash, and I should be sitting in cash, and then I can wait for the crash and get in while it's down. And what Joel is sort of explaining here is that that is one of the things that could happen, a crash, if the market is, let's say businesses are priced at 30 times their cash flows. One of the things that could happen in order for that to come back to 15 times cash flows would be that the market needs to drop 50%. But it's not the only thing that could happen. The other thing that could happen is that the businesses could grow their earnings by 100% and stock prices just don't move. So it's just as likely, and this is something that you need to understand, is that it's just as likely that the market drops when the market is expensive as if the market just stays flat for a number of years as earnings catches up to the price. Those are both things that could happen. Remember, we're talking about price compared to earnings or cash flows. Either prices could come down, that is one thing that could happen, but prices could just not move for 5 years while earnings slowly catch up to the price, and then prices and earnings can continue to go up.
We're really concentrating on companies that have 7, 8, 9% free cash flow yields in a 3% interest rate environment. And while some of those may be priced cheaply because the people are a little concerned about the future, even though they're earning lots of cash flow now, we try to stick to companies that are gushing free cash flow, huge returns on capital, meaning they deploy their capital well. That avoids some of the value traps from traditional value.
All right, so a lot to unpack here. So this is the part of the interview where he basically goes through and explains what he's looking for at the core when it comes to a business that is cheap relative to other businesses around it, the first thing that he says is that he's looking for a cash flow yield, a free cash flow yield of 7, 8, 9%, which cash flow yield is calculated by taking free cash flow and dividing it by the price. It's kind of like the inverse of a price to free cash flow. So in other words, he's looking for businesses with a multiple of between 11 and 14 or less. Of course, the lower the multiple, obviously the better. But not only is he looking for businesses that have a high free cash flow yield, lots of cash flow, gushing cash flows compared to the price, he's looking for those businesses to also be earning a high return on their invested capital. He wants businesses that are not only priced cheaply relative to their last year's earnings, he wants businesses that can take last year's earnings, reinvest it in the business, and compound it to grow cash flows in the future, because that's ultimately what matters. It's why I don't look at price to earnings or price to free cash flow really all that much, because I don't really care about what the company earned in a single year in the past. What I care about more is what are they going to produce in the future. Now, we might be able to use their past earnings as an indication of future earnings, but it's important to keep that as a distinct difference from expecting that a company is going to continue to produce the same cash flows in the future. We're looking at estimations in the future, and that means that we need to look at businesses that have proven that they can compound earnings at a high rate, and that is represented in the return on capital, return on invested capital figures that we look for within a business.
Prices have gotten pretty high, and like I said, that doesn't mean that the FANG stocks or some of the names that you're familiar with won't do well, or they won't meet the expectations that people think. It's just that as a group, the growth group, where people just pay up for expected growth over the next 5 years, that's probably, as you suggest, have been a little frothy. I would expect that to come back to earth.
What do you think the catalyst for that is going to be? Rising interest rates?
I mean, the real answer is I don't know.
I think this might be my favorite part of this interview, and there's a little bit to unpack here. So, Greenblatt is talking about the FANG stocks and how, I mean, certainly not Facebook, but some of the other FANG stocks and other really big tech companies at the moment have huge prices compared to their earnings and their cash flows. People are betting on a pipe dream. They're betting that these companies are going to produce a substantial amount of cash flow in the future. And he's talking about how that group of businesses, while every now and then one succeeds and you know them because they succeed, and it's kind of, you can look back on them and see, oh, that was the one that succeeded. But as a group, they generally underperform the market. They do pretty poorly. And we sort of haven't seen that group of businesses, at least at the time of this interview, see any substantial declines. And the interviewer is kind of pushing him to say, well, what's the catalyst going to be? What's going to be the cause? And his answer is perfect. It's, I don't know. I don't know. And the way I think about this is that these things happen over and over and over again. History just repeats itself over and over and over again many, many times. There will always be new and exciting industries that are seeing huge growth potential and that people sort of have no idea how big they're going to get or, what are the new directions that it's going to take. And people are willing to pay up for those pipe dreams. That will always happen. But the catalyst that causes the market to sell off, or a group of stocks to sell off, or a particular business to go through some kind of painful period is completely unknown. It's always different. So the correct answer here is always, I don't know what's going to cause it. I just know that that group of businesses historically is going to underperform because you're having to pay a huge price compared to cash flows. The funniest thing about the statement, I don't know what the catalyst will be, is that it kind of makes the entirety of CNBC pointless, because that's basically what they do on CNBC and these other channels. Even Bloomberg is guilty of it, is that they have people come on and basically give their opinion about things that we have no idea about. People coming on and saying, well, I think the trade war is going to end in 3 months, or this meeting is going to be the catalyst for the market. I mean, it's nice to kind of talk about it, but that's all it really is. You're just talking about something that you have no idea about what is going to happen. And as a rational investor, it's better to just not care what's going to happen. Look at the underlying business. Don't worry about catalysts and short-term events. Don't worry about any of that. Just look at the business, see what it can produce in the future, and compare that to the price that you're willing to pay.
You know, if you're buying a house, it's pretty simple questions. They're asking $1 million. Your job is to figure out whether it's a good deal or not. So one question you might ask is, if I rented it out and I could get $70,000 or $80,000 a year net of my expenses and interest rates are 3%, does that sound pretty good? How cheap is it relative to similar houses and all houses in all neighborhoods? So we look at a company, we say, how cheap is it relative to companies in the same industry? How cheap is it relative to all companies I can choose from? How cheap is it relative to how it's been priced over history relative to the market? These are measures of absolute and relative value that anyone would use to value any earning asset. We can't value gold or Bitcoin that way, and that's why we pass, okay? We don't value, but earning assets, there's standard ways that everyone would value them, and you know, if you don't go crazy and you're very disciplined about it, there's plenty of opportunities always.
Tons of value right at the end of this interview here. I encourage you to go via the link in the description below, watch the full interview after this, and check out that last bit again. It is so true. The way that you value any cash producing asset is pretty much the same. What am I going to get out of it? And what am I going to get out of it compared to what I'm paying? That would be the yield or the price to earnings and that sort of thing. Is the price too high relative to what I'm going to get out of it? And then not only is comparing the price to the earnings or the cash flows that you can get out of that business, compare that to other businesses in the same industry, like he said there. Compare it to same houses in the same neighborhood, or houses in different neighborhoods, businesses in different industries. That is all we're doing. We're looking at the return that we can get out of a business. We're trying to see how confident we are in our estimations. And then we're comparing that to the return, the alternative returns. What can I get out of a savings account? Savings account is probably the safest investment opportunity that you could look at. If you're only going to get 10%, am I willing to take a little bit more risk in the markets in order to make 5 to 10 to 15%? That is the kind of approach that you need to be taking when it comes to analyzing businesses. What am I going to get out of a business? When am I going to get it? And how sure am I? Those are the 3 questions that Warren Buffett would say that you need to be able to answer. So that is all we have time for today. And as always, as I said at the beginning, if you did enjoy this video, I put a ton of effort into making it. So go ahead and hit subscribe if you want to see more content like this, or just leave a comment down below if you don't want to hit subscribe. Some people just, you just don't want to subscribe. I get it. Your subscription box is full. I understand. I'm there too. When you have 20, 30, 40, 50 people that you're subscribed to, I get it. You don't want to add one more, and that's fine. But if you just leave a comment down below, that way at least you can let YouTube know that you liked the video, and then you can see my content pop up on the home screen. Do something. Let YouTube know that you want to see more of this if you don't want to hit subscribe. But thanks everyone for watching, and I'll see you guys in the next video.